Knowing exactly when to invest your money can be very challenging. There's lots of different factors to consider, and figuring out which stocks are the best for you could see the difference between you making a massive gain and seeing a huge drop in the value of your portfolio. In this video, I'll give you a complete guide to everything that you need to consider before making an investment. These tips will help you maximize your returns, minimize losses, and make your investing experience much smoother as a whole. Throughout this video, I'll be using some key guidelines that have been created by one of the greatest investors, Warren Buffett. These will help you determine how good an investment is and whether or not a company that you might be looking at will be actually a worthwhile investment. You can use this list as a criteria that you can check off to make sure that you are actually going to make a good investment with your money. If a potential investment that you're looking at ticks all these boxes in the list, then chances are you're on to a winning investment. Number one is looking at a company's moat. Now, a moat is essentially a competitive advantage. The same way that a moat protects a castle from attack, a moat will also protect a company from its competitors. There's lots of different types of moats, and the best companies have more than one. So I'll just give you a few examples and you'll start to build a picture of what to look for with your investments. So one of the main moats that a business can have is a brand moat, and this is where a company is very recognizable and can increase the price of its products without losing out customers. Think of, say, Coca-Cola with beverages, Nike with footwear, or Apple when it comes to phones. All of these companies can increase the price of their products but not actually see a negative effect on their profits. Think of all the different types of shoes that you can buy that are cheaper than Nike's, but you don't see Nike losing out on profits with the price of their shoes in comparison to other competitors. This is because Nike has a clear brand moat and brand recognition that consumers recognize and will actually sway their opinion in terms of how much price they're paying. If they compare a similar shoe to a Nike one, they might clearly be paying less for another off-brand shoe, but they are willing to part with more money just to make sure that they have that brand recognition that Nike provides. Of course, certain brands can be good also because of the quality of the product that they make, but the majority of the time the brand backing the actual item is the real reason why consumers are drawn to it. You can also look at switching modes. Facebook is a great example of this. It essentially has a vast proportion of the social media and messaging apps locked down, having Facebook, WhatsApp, Facebook Messenger, and Instagram all together in one company. This makes it very challenging to switch to another social media product without actually losing out on a lot of the functionalities offered by the Facebook brand, or Meta as it's called now. Essentially, if you're messaging anyone, you will be using one of the apps created by Facebook, and therefore if you change to a different messaging service, it will be more challenging for you because more likely than not, your friends will be using a service created by Facebook, and if you switch to a different messaging platform such as Signal, then you might lose a lot of the functionality that actually makes social media and messaging viable. Your friends might not be using Signal and therefore you can't get in contact with them, and this may make you stay with one of the other products offered by Facebook. Apple is also a good example of this. The functionality between an iPhone and an Apple TV, or the dongle attachments that you now have to buy to use things like HDMI cables or AUX cords, make it very challenging to use a non-Apple product with an Apple product without having to pay for another attachment or lose out on some of the functionality. There are also price modes, looking at something like Walmart, which can heavily undercut its competitors because of the size of the business and the bulk orders that they make. They can get products at a far cheaper price and can sell them for a far lower rate, drawing in more customers and make it very challenging for other competitors to keep up with them because they can't match how low their prices are. The best companies will have more than one moat, and there's other ones to keep in mind. I'll leave a link down below in the description box that will take a look at other different types of moats, but you always want to be asking yourself before you make an investment, what type of competitive advantage does this company have over others? Number two is looking at margin of safety. Now, the margin of safety is essentially a safety barrier for the investor. When you're looking at a business, you want to be buying it at a discounted price. With any investment, there's three different prices that you can pay for it. It can be either overvalued, undervalued, or just at the right price. So essentially, when you're making an investment, you want to be buying a company on sale when it's undervalued. And this is because it gives you a safety barrier for your investment and make sure that you're not paying too much for a company. If you know that an iPhone is worth $1,000, you're not going to pay $2,000 for it. Ideally, you'll wait until it goes on sale to say $800 before you buy it. And it's exactly the same principle with a company. Great place to find out the actual value of a business is looking at websites websites like Simply Wall Street, which will have it pre-calculated for you with a nice graph that indicates what the value of that company is. There's also quite a long calculation that you can make, and if you want to make the calculation for yourself, again, I'll leave a video to another channel that will show you the steps that you have to take to calculate the intrinsic value for yourself. A great thing when looking at the margin of safety of a company, there's certain things that can cause a drop in the share price of a business without having any fundamental changes in it. Looking at any scandals that the company might have gone through in the news, for example, the issue with Cambridge Analytica that affected Facebook's share price due to the perception around the company, but the fundamentals stayed the same. The number of active users on the website remained consistent, however this was not reflected in the share price, which was falling rapidly due to the bad press news that was coming out about the business as Facebook was going through a court case. The recent COVID pandemic was also a good example where the vast majority of companies saw huge drops in their share price. However, as time went on, they heavily recovered because the fundamentals of the business did not largely change. If you want to actually calculate the intrinsic value of a company for yourself, you can also use Phil Town's rule number 1 calculator for yourself too. Sometimes a drop in share price isn't necessarily a bad thing, and it can be a great buying opportunity. However, you do need to understand the fundamentals of a business so that you can accurately determine if the drop in share price is actually a negative event that's going to hurt the company long term, or if it's just a bit of bad press news and bad media perception around the business that's causing the drop in share price. So that leads me into my third piece of advice, is effectively researching a company. And to research a company, it has to have meaning to you. In order to understand the ins and outs of a business and how it operates, you have to actually be interested in that specific sector or in that specific company. If you're not really interested in technology, researching a company like Apple will have no meaning to you, and spending the time to understand it will be a far more challenging task than if you're actually interested in tech-based companies. And the reason you have to research a business is to understand its cash flows and how it operates, because the more understanding you have in a company, the more confident you will be in the investment and the more likely you'll be to hold on to it long term. Great place to get more understanding on a business is looking at things like a 10K report. This is just a large legal document that will give you a very detailed outline on a business, such as the management's goals for their company, their plans to grow profits, any risk factors that might negatively affect the growth of the business. You can easily find these on Google on the investor relations page for a specific company, or you can just search up the business followed by 10K report. So I can just type in Facebook 10K report, pick out the year that I'm looking for, and all of that information is readily available for me. Number 4 is looking at the company's management. So looking at things like the previous history of the management, what other companies have they been involved in, looking at something like Elon Musk, who previously owned PayPal, and also keeping in mind if there were any scandals or shady things that the CEO may have done at another company, and keeping in mind that they may have the same attitude for the new business that they are running. You could see the structure of their payments. Are they on a salary that will get paid out to them regardless of the performance of the business, or is the amount of money that they make directly tied to how well the company does? For example, a large proportion of Elon Musk's payment is based on Tesla shares, and therefore he is financially invested in the performance of that company to make sure that he can make money for himself. You can also look at conference calls and interviews from that CEO and see how they are answering questions from the media and the public, and how well they actually understand the ins and outs of the company that they are running. If you've made it this far into the video, make sure to drop a like for the YouTube algorithm. Now that you're familiar with some criteria to keep in mind before making an investment, you might want to look at some common investing mistakes. Check out this video on screen to learn from some of the mistakes that I made when I first started on my investing journey.